What if I told you that one of the most dangerous shipping lanes on Earth is quietly being protected by Bitcoin? Not by a navy, not by a treaty, not by an insurance giant on Wall Street, by Bitcoin. Right now, in the Strait of Hormuz, the narrow corridor that controls almost a fifth of the world's entire oil supply, something is forming beneath the surface of every headline you've read this week. And almost no one in mainstream finance is connecting the dots. Because this isn't a crypto story. Not really. This is a story about what happens when the traditional financial system stops working for entire nations, and something else quietly takes its place. Iran-linked entities, according to reports emerging from Middle East financial intelligence circles, are actively experimenting with crypto-based maritime insurance infrastructure designed to keep oil tankers moving through one of the most geopolitically volatile regions on the planet. Let that sink in for a moment. Insurance, shipping, oil, sanctions, and Bitcoin, all colliding in the same place at the same time. And here's what should concern you, not as a crypto speculator, but as someone who understands how global power actually shifts. This may not be a novelty experiment. This may be the opening move of something much larger. Stay with me through this entire breakdown, because what I'm going to show you in the next 18 minutes completely changes the lens through which you should be looking at Bitcoin, geopolitics, and where real financial power is migrating in 2026. This is the wealth continuum. And this is the story most people are going to understand too late. Quick note, nothing in this video is financial advice. This is analysis, context, and perspective. Always do your own research before making any financial decisions. And before we go further, morning, afternoon, or night, where you are right now, drop it in the comments. Because this community is genuinely global, and I want to know who's watching. Before we talk about Bitcoin and what it's doing there, we need to understand exactly why the Strait of Hormuz matters so much. Because if you don't fully appreciate what this waterway represents economically, the rest of this story won't hit the way it should. The Strait of Hormuz is a narrow channel, at its tightest point, just around 21 miles wide, sitting between Iran on one side and Oman on the other. Geographically, it looks almost insignificant. But economically, it is the single most critical maritime choke point on Earth. Roughly 20% of all globally traded oil flows through this corridor. That's not 20% of Middle Eastern oil. That's 20% of all oil that moves across oceans worldwide. Saudi Arabian crude, Iraqi exports, Emirati production, Kuwaiti shipments, all of it funneled through this one narrow strip of water before it reaches refineries in Asia, Europe, and beyond. And here's the thing most people don't think about. When there is tension in this corridor, and there is almost always some degree of tension, global oil markets don't just wobble, they panic. We saw it during the tanker seizures of 2019, we saw it during drone incidents in 2021, we saw it during the regional escalations through 2023 and 2024. Every single time military or political pressure intensifies near Hormuz, oil prices spike, shipping costs jump, and governments around the world start making emergency calls to their energy ministries. The world runs on oil. Oil runs through Hormuz. And Hormuz runs on a knife's edge. But here's what's changed recently. And this is the part most headlines are completely missing. The real problem isn't just military threat anymore. The real choke point now is insurance. Traditional maritime insurers, the massive institutions in London, New York, and Zurich that have underwritten global shipping for over a century, are becoming increasingly reluctant to issue coverage for vessels operating near conflict zones in the Middle East. And that matters enormously. Because here's something most people don't realize. Ships cannot legally operate without insurance. No coverage means no port approvals. No coverage means no trade financing. No coverage means cargo owners won't load their goods onto a vessel. Effectively, no insurance means no ship moves. So what happens when traditional insurers start pulling back from an entire region? The global energy supply chain starts developing cracks. And into those cracks, something new starts growing. Now here's the part nobody's paying attention to. And this is where Bitcoin enters the room. When traditional financial systems create barriers, alternative systems don't just appear naturally, they get built deliberately by people who have no other option. And that's exactly the environment we're looking at right now. For Iran specifically, the financial isolation isn't new. It's been accumulating for decades. SWIFT exclusion, dollar settlement restrictions, asset freezes, sanctions layered on top of more sanctions. These aren't inconveniences for Iranian trade. They are near total blockades of the conventional global financial system. And yet, Iran still moves energy, still conducts trade, still finds ways to participate in global commerce, just not through channels that Washington can easily monitor or control. That's been the reality for years. But now, reports are emerging that suggest something qualitatively different is happening. Not just moving money around sanctions through traditional gray market methods, but building parallel financial infrastructure using crypto rails, specifically to support maritime commerce, including insurance equivalent mechanisms for tankers and cargo vessels operating in the Gulf region. And if you're thinking, okay, this is just sanctions evasion, nothing new, I want you to slow down for a second, because the implications go far beyond one country avoiding one set of restrictions. Think about what maritime insurance actually does in the global economy. It provides financial certainty in uncertain environments. It creates trust between parties who don't know each other. It allows capital to flow into high-risk operations with calculated, distributed exposure. It is, at its core, a contract enforced by institutional credibility. Now, what does Bitcoin offer that mirrors those functions? Immutable settlement, trustless contract execution via smart contracts, global liquidity without a central intermediary, no jurisdiction that can freeze, revoke, or deny access. These are not the same things, and Bitcoin is not a perfect replacement for Lloyd's of London, but in an environment where Lloyd's of London simply won't participate, even an imperfect alternative starts looking like a lifeline. And this is exactly why this matters right now. Because we're not talking about a theoretical use case for crypto anymore. We may be watching a real-world use case emerge under real-world pressure in one of the most strategically critical trade routes on the planet. The question is, what does that actually mean for Bitcoin's trajectory? And what should you, as someone thinking about where wealth is moving, take from this? Because that answer is more complicated than most crypto commentators are willing to admit. Hold that question. We're coming back to it. But first, I need to show you the much bigger force driving all of this, because it's not really about Iran or oil, or even Bitcoin specifically. It's about financial power itself, and something in that power structure is quietly fracturing. Hit like if this is starting to make sense, because we're just getting into the deeper layer of this story. For most of the post-World War II era, the United States built something extraordinary. Not just military dominance, not just technological supremacy, financial infrastructure dominance, the dollar as the global reserve currency, SWIFT as the backbone of international payment messaging, Western-controlled institutions like the IMF and World Bank setting the rules, American and European insurance markets underwriting global commerce. This wasn't just economic success, this was control. When you control how money moves globally, you control global behavior. Sanctions become devastating because there's nowhere else to go. Trade pressure becomes effective because alternatives don't exist. Compliance becomes mandatory because exclusion from the system is existential. That's been the architecture of Western geopolitical leverage for 70+ years. And it worked extraordinarily well, until the system started being used so aggressively that adversaries, and some neutral parties, decided the risk of dependence was too high. Look at what's happened over the past several years. Russia, after the 2022 sanctions response following the Ukraine invasion, accelerated its development of alternative payment systems with China and willing trading partners. The speed of that pivot shocked Western analysts. China, watching what happened to Russia, dramatically accelerated its own de-dollarization efforts, the digital yuan cross-border pilots, the bilateral trade settlements in non-dollar currencies, the push to price more commodities in yuan-denominated contracts. BRICS nations, Brazil, Russia, India, China, South Africa, and the expanded membership that now includes Saudi Arabia, the UAE, Iran, Ethiopia, and others, have formally discussed reserve currency alternatives, even if they're far from implementing one. And across the global south, a quiet but persistent shift in sentiment is happening. Countries that previously saw the dollar-centric system as neutral infrastructure are increasingly viewing it as a geopolitical instrument pointed at them. That reputational shift is enormous, and it creates exactly the demand environment where decentralized alternatives, things like Bitcoin and broader crypto infrastructure, stop being fringe curiosities and start becoming strategic options. Now, here's where things start to break down for the traditional systems defenders. The argument against crypto has always been it's too volatile, too illiquid, too unregulated to be taken seriously. And for everyday retail transactions, that argument still has merit. But for geopolitical use cases, volatility matters less when the alternative is having your assets frozen entirely. Liquidity matters less when you're shut out of traditional liquid markets. Regulation matters less when the regulator is your geopolitical adversary. This is the calculus that sanctioned economies are running. And it's not irrational, it's actually quite pragmatic. What smart money is already watching is this. If Bitcoin, or crypto infrastructure more broadly, becomes genuinely embedded in global trade mechanisms used by nations that together represent a significant portion of global GDP and energy production, the demand profile for Bitcoin changes in ways that current market models don't adequately capture. This isn't retail adoption. This isn't ETF inflows. This is something categorically different. And the next question is the one that should make you genuinely uncomfortable. If Western governments understand this, And they do. What are they going to do about it? This is where the story gets genuinely difficult to sit with. Because Western governments, particularly Washington, face a problem they didn't fully anticipate when Bitcoin emerged. They can't simply ban it globally. They can restrict it domestically. They can regulate exchanges. They can pressure financial institutions. They can create compliance burdens that push casual users away. But they cannot eliminate a decentralized network that operates across every jurisdiction on Earth simultaneously. And that asymmetry is the source of a very real policy nightmare. Think about it from Washington's perspective. For decades, the ability to exclude nations from the dollar system was one of America's most powerful non-military tools. Sanctions on Iran that actually worked. Pressure on North Korea. Isolation of Russia's energy financing post-2022. These tools required one critical assumption, that there was no credible alternative. Bitcoin threatens that assumption. Not today in its entirety. Not completely. Not for all transactions. But directionally, the trajectory is deeply concerning for anyone whose geopolitical leverage depends on financial system control. And here's the uncomfortable nuance that most people in finance aren't willing to say out loud. The United States government doesn't just need to worry about adversaries using Bitcoin to evade sanctions. It needs to worry about neutral nations watching adversaries do it successfully, and then quietly building similar capabilities as insurance. Because once the precedent exists, once it's demonstrated that decentralized rails can support real-world trade in high-pressure environments, the option value of those rails increases for everyone. That's the cascade effect Western policymakers are actually afraid of, not one rogue state, but a gradual normalization, a quiet consensus that emerges country by country, trade route by trade route, until one day the dollar system still exists, but its exclusive power is gone. Now, does this mean Bitcoin is about to replace the dollar? No, that's not what I'm saying. Global reserve currency transitions take decades, sometimes generations. But the petrodollar system, the arrangement by which oil is priced in dollars, creating persistent global dollar demand, has faced more structural pressure in the last 5 years than in the previous 30. And stories like what's happening in the Strait of Hormuz are not isolated data points. They are indicators of a direction, small cracks in a structure that has held for a very long time. And what happens next is the real story, because the response to those cracks is going to shape global financial architecture for the next 20 years. Do you think the system can hold? I'm genuinely asking. Drop your view in the comments, because this is exactly the kind of thing I want this community thinking and talking about. Now I want to connect the last piece of this, because most commentators are leaving it out, the oil connection. Oil is not just the world's most important commodity. Oil is the foundation of the modern dollar's global power. Here's the history compressed into 60 seconds. After the Bretton Woods gold standard collapsed in 1971, the dollar needed a new anchor. An arrangement was reached with Saudi Arabia, and later OPEC broadly, that oil would be priced exclusively in dollars. This created structural, perpetual global demand for dollars. Every country that needed to import oil needed to hold dollars first, which meant countries needed to earn dollars or borrow dollars, which reinforced American banking supremacy, treasury market demand, and geopolitical leverage simultaneously. This is the petrodollar system, and it has been one of the most quietly powerful geopolitical arrangements in modern history. Now, look at what's been happening to it. Saudi Arabia has conducted trial oil sales to China in yuan-denominated contracts. Russia is pricing energy sales to India in rupees. UAE has explored dirham-settled trade with several Asian partners. And now, entities operating in the Strait of Hormuz corridor are experimenting with crypto-settled maritime insurance. None of these individually shatters the petrodollar, but together they represent something that economists call marginal erosion. The petrodollar doesn't need to collapse overnight to lose relevance. It just needs enough alternatives to emerge that nations start treating dollar dependency as a choice, or rather than a necessity. And once it becomes a choice, the strategic leverage changes completely. Here's the Bitcoin wildcard nobody's modeling correctly. If, and I want to be careful here because this is still early and uncertain, but if crypto infrastructure starts genuinely embedding itself in energy trade settlement mechanisms, even at the margins, Bitcoin's relationship with oil becomes something no traditional financial model has ever had to price. Think about what that would mean for demand. Right now, Bitcoin's price is driven largely by institutional adoption, retail speculation, ETF flows, and macro sentiment around inflation and monetary policy. Those are real drivers, but they're all, at their core, based on Bitcoin as an asset class. What happens to Bitcoin's valuation when it starts being demanded not just as an asset, but as a functional settlement layer for global energy trade? That's a different question entirely. And the honest answer is, nobody knows with precision. But the direction of the answer is fairly clear. When real-world transactional demand enters a market with constrained supply, prices respond. This is where smart money is already moving, not into the speculation angle of this story, but into the structural demand angle. Because structural demand is durable, retail speculation is not. And if you're watching this channel because you want to stay ahead of where wealth is flowing before it becomes obvious, this is the signal worth tracking. Bitcoin has worn many identities over its 16-year existence. First, it was internet money for libertarians and tech idealists. Then, it was dark web currency. And the media ran with that story for years. Then it was digital gold, a store of value, an inflation hedge. Then it became an institutional asset. ETFs launched. Wall Street desks opened. Governments started holding it. Each of those phases was real, but each of them was also incomplete. Because the identity that may ultimately define Bitcoin, the one that rewrites how sovereigns, central banks, and geopolitical strategists think about it, hasn't fully arrived yet. Geopolitical infrastructure. That's the identity forming right now, and the implications are profound and not entirely comfortable for Bitcoin advocates. Because when Bitcoin becomes geopolitically relevant, when it starts appearing inside trade routes, energy systems, and sanction circumvention architecture, it stops being a neutral technological curiosity. It becomes a contested asset. And contested assets attract serious attention from serious governments. The regulatory environment around Bitcoin over the next decade is almost certainly going to be shaped significantly by how deeply it embeds itself in these geopolitical pressure points. The United States and its allies are watching, not passively, actively working to understand, model, and ultimately find ways to limit the strategic utility of decentralized rails for adversarial nations. That means more regulation, more surveillance infrastructure, more pressure on exchanges to enforce compliance with geopolitical restrictions, potentially more aggressive international coordination on crypto monitoring. So let me be completely direct with you. This story cuts in two directions simultaneously. On one side, Bitcoin's strategic relevance is rising faster than most people understand. The demand case is evolving from speculative to structural. The geopolitical tailwinds are real. On the other side, the political headwinds are going to intensify proportionally. The more useful Bitcoin becomes for circumventing the dollar system, the more aggressively the dollar system will fight back. The tension between rising relevance and rising resistance is going to define the crypto landscape for the next decade. And investors who understand both sides of that tension will be far better positioned than those who only see one. Subscribe if you want to stay ahead of what's coming, because this channel is going to keep breaking down exactly these kinds of developing situations as they unfold in real time. Let me zoom all the way out now, because I want you to see the full picture. We've talked about the Strait of Hormuz. We've talked about sanctions and financial isolation. We've talked about the petrodollar. We've talked about Western geopolitical leverage and its limitations. But there's a pattern underneath all of it that matters more than any single piece. Conflict zones and moments of geopolitical pressure have historically been some of the most powerful accelerants of technological adoption. The internet wasn't just invented in a lab. It was turbocharged by military defense funding and the Cold War logic of distributed communications that couldn't be knocked out by a single strike. GPS was a military technology before it became something on your phone. The semiconductor arms race between the United States and the Soviet Union created the modern chip industry. Satellite communications infrastructure was built to an enormous degree by defense spending and geopolitical competition. Every time global pressure intensifies, the technologies that provide resilience, redundancy, and independence from central control get supercharged adoption. Decentralized finance, and Bitcoin specifically, fits that pattern almost perfectly, and we may be in one of those acceleration moments right now. Look at the geopolitical environment of 2026 honestly. The US-China rivalry has moved from a trade dispute into a structural competition spanning technology, currency, military posture, and diplomatic alignment. Global debt levels, across both developed and developing nations, have reached points that create persistent pressure on currency stability. The IMF estimated in early 2026 that emerging market debt servicing costs were near their highest levels in 3 decades, with several nations under active currency strain. Sanctions have become so common as a geopolitical tool that the list of fully sanctioned or partially restricted economies now covers a significant share of the world's population. Regional conflicts, from Eastern Europe to the Middle East to the South China Sea, have become normalized features of the geopolitical landscape rather than exceptional crises. In that environment, the demand for financial tools that are neutral, that don't require permission from any government, that can't be selectively denied based on political alignment, that demand is structurally growing. Not because of a Bitcoin ETF launching, not because of a celebrity endorsement, not because of a bull cycle driven by retail excitement, because the world itself is creating the conditions where Bitcoin's core properties become genuinely useful at the sovereign level. And this is why I keep saying the next phase of Bitcoin adoption may be driven by necessity, not hype. Hype-driven adoption creates volatile cycles. People come in when prices are rising and leave when they fall. Necessity-driven adoption is different, it's stickier, it's structural. It creates floors rather than just peaks. Share this with someone who needs to see this before it's too late, because the window to understand this transition before it becomes fully priced in is closing. I want to leave you with this. When I started putting this video together, the instinct might have been to make it a simple Bitcoin bull thesis. Bitcoin is going up or down because oil tankers are using it. Buy now. But that would be intellectually dishonest, because the real story here is simultaneously more bullish and more complicated than that. It's more bullish because what we're watching in the Strait of Hormuz corridor, if it develops the way early indicators suggest, represents a category shift in how Bitcoin is perceived and used by sovereign-level actors. And sovereign-level actors have the capital, the time horizon, and the strategic motivation to become very serious holders and users of assets they decide are strategically valuable. 5 years ago, El Salvador adopting Bitcoin as legal tender felt like a curiosity, an outlier, almost a joke to mainstream financial media. Today, multiple countries have passed crypto reserve legislation. The United States has actively discussed a strategic Bitcoin reserve. Dozens of sovereign wealth discussions include Bitcoin as a potential allocation. The pace of that transition from fringe curiosity to serious sovereign consideration was about 4 years. What's the pace of the next phase? From sovereign consideration to geopolitical infrastructure? That's the question serious investors should be asking. But here's the complication, the risk side of the same story. If Bitcoin becomes deeply associated with sanction evasion and geopolitical workarounds by Western government narratives, it could trigger a level of regulatory and enforcement pressure that the market is not currently pricing. The OFAC actions we've seen against crypto mixers and certain exchanges in recent years were previews, not conclusions. A concerted, coordinated multi-government crackdown on crypto infrastructure used for sanction evasion could create enormous short-term disruption, not necessarily long-term destruction, because the network itself is designed to survive that kind of pressure. But short-term disruption? Absolutely possible. And smart investors account for that scenario. So what's the takeaway? 1. The geopolitical use case for Bitcoin is moving from theoretical to actual. That is a significant structural change in the demand story. 2. The political risk is also rising proportionally. Higher relevance means higher threat perception from incumbents who benefit from the current system. 3. The timeline matters. Early movers. In understanding this transition, not just price speculators, but people who understand the structural shift, are positioned very differently from those who will eventually see it on the front page of mainstream financial media. 4. This story is not finished. It's not even close to finished. What's happening in the Strait of Hormuz right now may look in 10 years the way early internet commerce experiments looked in 1994. Rough, imperfect, but directionally correct about something enormous. What would you do if this actually plays out exactly the way the early signals suggest? That's the question I want you sitting with. Not, is Bitcoin going up next month? But, am I thinking about the right frame for what Bitcoin is becoming? And what that means for where you want to be in 3, 5, 10 years? Because the difference between those two questions is the difference between trading noise and positioning for signal. This is the wealth continuum. If you want to keep staying ahead of where wealth is actually moving before it becomes obvious, subscribe and turn on notifications, because we're going to keep pulling these threads as they develop. If this video gave you something to think about, something beyond the typical Bitcoin takes, hit like. It helps this analysis reach people who are trying to think about the world differently. And drop a comment, especially if you see the story differently than I do. Because the most interesting part of this community is when people challenge the frame. What happens when governments realize they might actually need the thing they've been trying to control? That's the question that defines the next chapter. Stay sharp, stay informed, and stay ahead.